Looks like people coming in through all throughout North America here. Awesome stuff. Really curious to kind of hear, because today we're going to go over the profit and loss statement. How confident are you in regard to just the profit and loss statement in general? Maybe if you want to grade yourself 1 through 10 in the chat, 10 being you're an expert, 1 being you have a lot of opportunity to learn. Kind of curious to see where everyone's at with that. And for those that are just joining right now, we're just going to wait a few minutes here. Looks like we have quite a few people joining, so great stuff. Looking forward to this. First of 3 webinars as part of this webinar series. Actually, the first webinar series that we've done. So super excited here. All right, so we're seeing some 1s, 4s, 5s, 6s, -10. Matt, I don't think you're giving yourself enough credit. I'm sure you're at least a 1 or 2. Come on. Awesome. So definitely some area to improve here and learn some more. So awesome stuff.
Hey everybody. So what? So 1 is good and 5 means
1. No, 1. So like I said before, for those that are still looking to learn a lot more about the P&L, not too comfortable with it, measuring more of a 1 through 10, 10 being, really a master, which I want to create a lot of 8, 9s, 10s today. That's the goal. And I think we can do it. And, I think this is, really excited to see this many people joining. Looks like already over 100 people here that joined us. And I know it's a busy time of year, but it's great to keep stuff like this front of mind.
No, I'm excited about this webinar series because as an accountant, I can finally just get a chance to geek out with all of you on this accounting stuff. But at the same time, I'm truly passionate about helping business owners learn about their financials and be able to feel confident in that and not feel lost, because the financial statements are there to guide you in making the right decisions for your business, your families, your employees' families, all of that, based upon your goals, right? So it's much more than just the financials. It's supposed to be there to help guide you. So super excited to dig into it.
Yeah. And, today is going to be useful whether you're a solo operator or you're part of a multi-million-dollar company. And we have different case studies that are in both, we really want you to have some takeaways here.
Right.
So that's really the goal. And, as I mentioned in the beginning, this is the first of 3 webinar series. On Friday, we're going to take a deep dive into the balance sheet. And next Wednesday, we're going to go over the cash flow statement, which I think are even a little bit more of, sometimes tricky financial statements to navigate. But for those that are not aware of Cycle CPA, so we're a remote accounting firm. So we do everything from bookkeeping to advisory level services and tax services as well. So it's really mixed between doing the actual accounting work, but then also some of those more advisory based meetings where we can help you make some of those managerial decisions in the company. Carla's my wife, one of the CPAs here, the other co-founder. And we have a remote team and we're fully dedicated to the green industry. So that's our focus here. And we want to take that knowledge and our experience and, really pass that on to you guys here today. We'll kick things off.
And this is being recorded. You'll get a recording of this. So don't worry if you don't take all notes. And then I definitely encourage everybody. We're here to help you learn and answer any questions. So please drop your questions in the chat as we're going through this webinar. I want to make sure everybody's getting the most out of this.
Yeah, and that's really, I think, the beauty of being live.
Right.
Is so that you can ask those questions and we can help you out with those. So as mentioned, today we're going to dial into one of the three main financial statements called the profit and loss statement, also known as the P&L. So you might hear us utilize that terminology today, also known as the income statement. Basically, you're looking at, the business's revenue, so all the sales that are being generated, right? Also, some people refer to as top line sales. And then all of the costs that the company incurs, which we're going to go a lot more specific into, within this webinar, whether it's direct costs and overhead costs, right? And you can break this report out between specific periods. So you might look at a profit and loss statement for a month. You might look at it for a quarter. You might look at it for a year or a couple of years. Today, we're going to look at it in different ways, right? So really the goal of this is to be able to show, okay, are we making a profit, right? Are we in the positive, or are we incurring a loss over time? And when we're looking at the profit and loss statement, as I mentioned, you can look at it month to month. You can look at it yearly. One of the good ways to look at your numbers is also compare year over year, right? Which basically means, for instance, comparing, okay, how are we doing this year from January up until the end of March in comparison to January to the end of March for 2025. Especially in a seasonal company, it really helps to give you that accurate picture and how you're performing. That way, especially for those companies that are doing maybe snow services, right? You're comparing those similar services to the same that you did last year. Versus it's difficult to get a little bit of clarity if you're comparing how you're doing in lawn maintenance versus snow plowing services, right? When those different months occur throughout the year. And then also looking at what's called a rolling 12 basis, which basically means no matter where you are throughout the year, you're basically taking a snapshot of those 12 months. So a lot of companies look at it more based on, okay, how did we do in the year of, let's say, 2024, which is great, but you can also look at it from March of 2024 up until March of 2025, right? So looking at it in that basis as well, that way you can kind of get that full scope of the seasonality of your business, but it's also the most the most current information as well. Also, when it comes to profit and loss statement, being able to view it based on service lines. So whether you're doing maintenance or install-based work, and as we look at some of the P&Ls today and we take a deep dive, we're actually going to look into ones that are more of install-based companies versus ones that are all maintenance, or ones where it's kind of mixed. And that's one of the great things about being able to look at your numbers in that way is ultimately you want to get granular so that you can find those different opportunities to improve. And then also things like location tracking, right? Similar to service lines, right? You're kind of breaking out the company so that you can really see what is performing best. Looking at benchmarks, right? Okay, how does it compare to the average company in the industry? So using that as a baseline. Also thinking about, okay, material intensive work versus less material intensive work. As a whole, the green industry encompasses tree services, landscape, lawn care, hardscape, outdoor living, irrigation, right? So there's a large amount of services, but at the end of the day, a lot of it boils down to, especially when it comes to looking at the profit and loss, okay, are we looking at a company where they're installing material, where it's material intensive, or are we dealing with a service line or a company that is more labor intensive, right? So there isn't much material kind of baked into the profit and loss statement. So keeping a lot of these things in mind as we get introduced. Now, when it comes to the profit and loss statement, you have the revenue, right? Which some people refer to it as top line sales. That's all the income that the company is going to generate, right? Before any costs are incurred. Then you have what's called cost of services, also referred to as cost of goods sold, direct costs, right? These are the expenses or the costs within the company that you can tie directly to work being performed in the field. So, for instance, you go out and buy landscape material, you know that that's going to go to a specific job, right? Or you have certain disposal costs. After you're done with the job, you know that that is associated with that specific job, right? So even things like direct labor, or also known as field labor, right? So think of that as anyone who's actually physically working on the project. So they're actually the ones getting their hands dirty, working in the field. Then you have your gross profit, right? Which is basically what's left over, right? Once you take your revenue minus your cost of services, that's your gross profit. A common mistake we see is when companies, even maybe in some Facebook groups, and you kind of even compare numbers with friends, and sometimes people think that that's your profit, that's your bottom line net profit. But of course, and unfortunately, there's other costs that the company incurs, kind of those back end expenses, also known as overhead expenses. Some might refer to as operating costs or indirect expenses. Those are all of the back end costs of the company that you can't necessarily tie to a project being performed in the field. And what do I mean by that? So for instance, if you have software costs, right? That's a general cost of the company. It's not just for a specific job, right? You can spread that cost out, across all the contracts or jobs that you're performing for that year, or accounting fees, or administrative salary. So anyone who's not actually physically touching the work in the field. So management people, admin people, people that help you answering the calls in the office, dues and subscriptions, right? So we're going to see this, like I said, more broken out in a case study where you're going to see that, but just understanding kind of that philosophy behind, okay, what is overhead versus what is cost of services? And then you have your net profit margin, which is your bottom line net profit, right? That's what you're left over with. And we're going to get a lot deeper into cash flow and kind of the reality of what's left in your bank account at the end of the day, because there's other factors that really influence cash flow, but net profit is a big thing that impacts cash flow. So if your net profit's high, it's going to put you in a good position to be able to really, really generate high cash flow as well. And then as for gross margin, typically the average in the industry is around 60%, or I should say the average gross margin is around 40 to 45%. And the goal is to be above that, right? I would say above 50%. Net profit margin, a great goal is to be in the 15 to 20% range. Average is closer to around 5 to 7%. So just to kind of give you a general idea as we kind of dive into things. And, here's just another graphic just to kind of show, you have your total sales, right, which is your total revenue. That's this green line here. Then you have your cost of sales, as we discussed, right? Those are all your direct costs, everything you could directly tie to the work being performed in the field. And your gross profit is really what that difference is, right? So you take your revenue or total sales minus your cost of sales, that's your gross profit. But like we had mentioned before, what is B, right? What are those expenses that the company has to incur that are ultimately going to get in the way between you making all your gross profit dollars, right? It's, but after those costs, which is B in this example, is your net profit. So would love to see if anyone in the chat can give us an idea of what kind of cost category would B fall into. You could put your answer in the chat.
While we're waiting for people to answer in the chat, somebody did ask a question that, when would you consider fuel as direct cost versus overhead cost? Now, that's the only thing that's kind of arbitrary in the chart of accounts. Some people put fuel in direct costs, and some people don't, because if you're not specifically costing fuel to a specific job and it's not part of your estimate, which is probably not, then it should just be part of your overhead, because that's how you're recouping it anyway. But if it is, you could put it in cost of goods sold. So that's pretty much the differentiator there.
And it looks like we're getting some different answers. Some of them are semi-correct. It's part of overhead costs. So that's really what it is. So overhead, which marketing, repairs and maintenance, admin fees, those are all things that basically encompass that. So awesome job. And when you look at your profit and loss statement, it can really be boiled down to when you're looking to make improvements to your profitability. Is it a pricing adjustment, right? Is it something within that category that we can increase pricing, or can we increase efficiencies, right? Is there a software or technology, or do we need to hire better people, or increase or improve our training process, or make certain improvements there? So understanding that oftentimes improvements are going to fall into those two main categories. All right, so now we'll dive into some of the examples here. And the first company that we're going to be looking at is a company that does more of the install-based services. So it's more of a material-intensive company, and they do about 1.1 million in revenue. So that's what we're going to look into first.
Yeah, and they're all real-life scenarios, so we thought it would be interesting to go through them. So first, I guess once you have a profit and loss statement, you want to know how you should analyze your profit and loss. So I'm going to give you a step-by-step approach to that. So a way to analyze your P&L is as a percentage of revenue. So for example, salaries and wages for direct labor or field labor as a percentage of revenue. So for this company, you can see in 2024, they came in at 32% of revenue. So salaries and wages take up 32% of revenue. So for every dollar of revenue that this company made, 32 cents was spent on salaries and wages. So it's nice to look at a profit and loss in this way because it's easy to compare everything to revenue for the current year and the prior year, and then you can see whether it had increased, decreased, if you see the trend here on the right. So let me clear this really quick. So, and then somebody asked, oh, do you review this annually? So for this example, we're going to be reviewing it annually, but you can do it monthly, quarterly, however you would like. Like for us, our accountants would be reviewing January through March 2025 versus that same period in 2024. You just want to make sure you're reviewing the same period against each other, because you wouldn't review like quarter one versus quarter three of last year. That just doesn't make sense because of the seasonality of things, right? So in this example, we're just going to be reviewing a profit and loss annually. Again, you can do this monthly, quarterly, however you would like. So here's 2024 as a percentage of revenue versus 2023. And on the right, there's a trend. And this format here is our CycleScape report, but you can pull this up in any accounting software. So if you use QuickBooks Online or Xero, it should give you this view. So the first thing that I'll do is I'll go over revenue growth. So this company grew at 5% in 2024 versus 2023. So they had a good steady revenue growth, right? And they actually have increased, because in the prior year, actually they had declined. So that's good that they grew in revenue, right? That's where our brain goes. Good. But when you look at revenue growth for your business, the next thing you want to see is like, you want to compare the expenses and the growth of those, right? Because if I see here, my total cost of goods sold actually decreased by 0.93%. Now, is that a positive or a negative thing? And it's a positive thing, right? That my revenue grew at 5%, but my total cost of sales expenses decreased by almost 1%. So that's good, right? You always want to analyze the growth here of your revenue against the growth of your expenses. Because if I had revenue growth of 5%, but my cost of sales grew by 10%, that wouldn't be good, because that means that my expenses are growing at a faster rate than my revenue. And so that my revenue, grew for no reason. Like, I wasn't able to retain that in gross profit, right? So then we see that they did good with that. So their total cost of sales remain the same, almost. And another thing here is that, another thing to note is that the materials did increase by about 1%, which is not a totally big deal, but just something to keep in mind. But I think that the total highlight of this is that this company did well because their cost of goods sold didn't increase at the same rate. Somebody said, how do you come up with the revenue percentage? It's like, for example, salaries and wages, the amount of salaries and wages divided by revenue.
Yeah. And so let's say, like in this example, this company was doing around 1.1 million in sales, right? So you do the 1.1 million times 0.32 roughly, right? Which is, so it's roughly 352,000 out of that 1.1 million in sales is your salaries and field labor wages, right?
And you don't have to calculate all of this like in QuickBooks. If you pull up a report as a percentage of revenue, it'll automatically do that for you. So It's a standardized thing.
Yeah. And one of the big things when it comes to reviewing a financial statement like this is start more from the bird's eye view, because then it will enable you to see, okay, where should we then focus in on most, right? So as Carla mentioned, they had great revenue growth, or I shouldn't say great. It's around average. The average company grows around 5 to 10% each year. But you can see that their total cost of goods or direct costs, as we mentioned before, it didn't increase as much. Then you look at all your indirect or your overhead costs, right? So all of those back end expenses, you can see that this company, when you look at the totals, so I can use the whiteboard here. It actually decreased by 5%, which is phenomenal. It went from 29% to 24%. And this is also when the average overhead is typically around mid-30s. So not only it was actually good last year or decent last year, but then it actually improved even more in 2024, right? So looking at it more from a bird's eye view, now we kind of have an understanding of, okay, listen, our total cost of goods, our goal, we actually want to improve a little bit more in that, or we see a little bit more of an opportunity, because maybe around 2 to 5% we can probably improve there within your direct costs, versus in your indirect costs there isn't as much of an opportunity because you're already operating in a pretty good way there. One of the biggest reasons why is also because of the overhead salaries being low, right? Typically for a company, it's going to be around 10%. So again, start with those bigger categories when it comes to the total overhead and then the total cost of goods. And then you can dial into, okay, what do I need to focus on more? What do I need to prioritize for this next quarter? And then dialing it in there. Also, as we kind of look at this company, there really wasn't any major increases or decrease within the cost categories. I think having the low overhead is an exciting thing because then it allows you to really scale at a faster rate, right? You can kind of use that as a competitive advantage, especially when you're bidding out different jobs. And every company optimizes in different ways as well. So this company might have low overhead salaries because maybe their direct labor or the people working in the field, maybe they require less oversight. Maybe the way that this company is approaching it is they're investing more into getting quality employees to work on the projects, requiring less administrative oversight, right? Whereas other companies, maybe they're a little bit more management heavy or more heavy in the administrative side of the company. So again, you're kind of looking at this from a bird's eye view first. And that also means even also looking at your net income as well. So you can see this company, their net income is around 19%, which again, that was an increase of about 5% from the previous year. So overall, I would say this company is operating well. It's especially when the average net income is closer to around 5 to 7%. So please, if anyone has any questions in the chat, this is the first of 5 profit and loss statements that we're going to take a look at. And I would say even in regard to overhead costs, the similar way that you would approach it in regard to how you end up incurring a lot of these costs over time, which is generally slowly, right? Year after year, you're kind of adding different items in. Take that same approach when you're looking to really manage it or decrease it, right? Focus on one and try to see, okay, what are some ways we can decrease this? And then also understand that some of these costs within overhead, some of these are more based on ROI, while others, it's kind of, you're just looking for really the smallest cost, right? So things like utilities or rent or insurance, office supplies, right? It's like, okay, how can we decrease these as much as possible? Whereas things like marketing, okay, if I'm going to spend a little bit additional in that, right, where the average company is going to spend 1 to 2%, you might spend more, but ultimately you're going to look for an ROI on that, right? Like that might actually make you make higher profits. So again, I think overall this company has a lot more to work on in regard to some of the direct costs. They're already operating pretty lean in regards to some of the indirect and overhead costs. So I would say we can move on to the next P&L. So this one is of a company that is small, a little bit smaller in size. So this company's about 180,000 in revenue, and they focus more on the maintenance and reoccurring services. So first off, when you look at this, you see, okay, revenue growth was higher than the average company, right? So it was around 17%. And not only that, you can see that they're really managing their direct costs well. And as I mentioned before, right, starting more from that bird's eye view, looking at the direct costs, okay, they're managing that well. And then also looking at the total overhead costs, which again, managing that very well, right? When a company is typically going to be in that 30% range, this company is doing very well. But Now we're going to dial into why, right? Why are they operating so well? Typically, for a company that's a solo operator, that's the most profitable that you're ever going to be, right? And especially if you want to scale the company, you need to be profitable because you're going to be then fitting in other salaries and other additional expenses as you scale. So if you're a solo operator, or if you have minimal help in the field so far and you're not profitable yet, I would recommend first doubling down and really trying to figure out, okay, how can we increase pricing or improve efficiencies to really get there first. So now we can dial into some of the direct costs. Now, why is it that the total direct cost or total cost of goods is only 18%? It's because this company doesn't have a field labor expense yet, right? So it's most likely a solo operator, and instead of receiving salaries as a W-2 wage, they're getting draws, right? So owner's distribution here. So in essence, especially for a maintenance company, this field labor in the future is going to be 25 to 30%. And let's say, just to be conservative, let's make that 30%, right? As they look to scale, they want to grow in the future. Now, if you tack on that 30% as the field labor, that's going to get added to the 18.8. So that's going to be closer to around 40, 48, even let's just round it up to 50%, right? Which as a goal, as your cost of goods, that's a pretty good place to be. Now, how about some of the and before we go into the overhead costs, actually, just do want to make one other note here as we look at the fuel costs. Typically, it's going to be around 4%. This company is a little bit high, So, and sometimes we see this, especially with newer companies or smaller companies. You maybe started taking on jobs that were all throughout the town, right? But then you kind of realize as you scale, route density is a huge thing when it comes to some of those recurring services. So that could be a reason here. Maybe they took on some clients that they shouldn't have taken. Because maybe, especially, you're kind of eager just to get into business and take on any clients you want, but that could be something there, to also improve on as well. So we can also look at some of the overhead costs. One of the things that kind of sticks out to me, I think, having such a low marketing spend, there's definitely opportunity. So I think it's great, as something as this company thinks about growth, you have more than enough room to be able to invest into whether online marketing means or other direct mail items there. Merchant fees is a little high, but again, it's important to kind of think about, okay, yeah, that might be high, but is that saving them time, right? Is this enabling them to instead try to chase their customers down for payments, to maybe work on a couple extra properties or, spend more time in sales, right? So thinking about, okay, what is the return that we're basically getting on some of these expenses? And, although overhead is actually went up by 4% from the previous year, 4.7%. Yeah, that may not be ideal for overhead to go up. But again, if a company is going to grow, like this company grew 17%, sometimes the overhead is going to go up as you make certain investments. But not only is it okay because of that, it's also okay because 60% is incredibly low anyway, right? When the average is around 30%. So look at trends, look at different metrics, right? But also having an understanding of, okay, what are the goals that we're trying to get to? And there is actually a bad thing about being too lean, right? Because if your overhead is too low, then sometimes that means that you're running a fantastic operation, right? But it can also mean that you're not supporting the core operations enough, right? Or maybe you're not you're spending too much time on administrative items, right? And you're not investing in the right way. So, thinking about all those different things. But I would say overall, this company is ready to scale. That's how I would categorize this. Carla, any comments here?
I think just keeping in mind that the overhead salaries, I think it's a big thing that the overhead salaries is 0 here. I think sometimes when we're like a lot of the solopreneurs or people that just maybe have like their first employee, look at the profit margin and think it's, oh, I have a really high profit margin, and which is good, but you just need to make sure that you're backing into the cost. So like Joe mentioned, the rent, utilities, and telephone, maybe not something that you have right now, but you will have in the future. So that's why your profit's going to be on paper is going to look really high because you don't have that. When we run into issues is when it's like a solo operator or and the profit is still low and there's none of those expenses, there's no salaries, then like Joe said, then that company would not be ready to scale. But this one has good numbers and has that availability there, right? Where they're going to grow into those costs, if that makes sense. So just keeping that in mind.
Absolutely. And so now we're going to move on to the next company. So this company is more of an install-based company, doing around 4.7 million in sales. And
well, the growth rate is less than it was last year, right?
Yeah, so that's something to consider. So they're actually growing at a slower rate than the average company. Another thing,
and that the growth dropped tremendously, but that could just be that numbers sometimes when you look at percentages has a different impact on things, right? So so that could be something. But I think that looking at 2024, they grew about 4%. Again, my eye is going straight to total cost of goods sold, and that increased by 1%. Is that a positive or a negative thing? Again, that's a positive thing, right? Because your costs are not exceeding your growth rate. Although it did go up a little bit, that's fine. That's because your revenue went up, right? But I think the major thing here is that salaries and wages, field labor went up by 6%, right? Along with the materials, and they are using less in subcontractors though by that same amount. So subcontractor percentage went down by 6, and for me, to me it looks like they bought more of their labor in-house this year, and so they traded one for the other. And I mean, it looks like they're a tiny bit more efficient with their in-house labor, right? Because that went down 6.8, but salaries in field went up by 6.6.
Yeah. So when you look at your salaries in field labor, right? So those are the W-2 internal employees. Then you have the subcontractors, right? And sometimes you can look at this if you even add them together. So in this example, it's roughly around 30%. The average for more install-based companies is going to be closer to around 20-25%, right? So they have some room for improvement there. And as Carla mentioned, it's interesting because you can see here clearly they were actually spending more or putting more resources into internal employees in 2024 versus in 2023, they were utilizing more subcontractors, or more of their work was actually subcontracted out. Now, again, is that a bad thing? Ultimately, in this example, their cost of goods increased slightly, so it wasn't the most ideal if you just look at it in the year perspective. But maybe they were making investments internally to then kind of scale to that next level, right? So it's always kind of looking into, okay, what was the reason behind these decisions, and looking at the profit and loss and monitoring it. It can kind of help to give you insight into, okay, how did these decisions that we made, how did it actually play out throughout the year?
That's what you're getting. This is your feedback, right? When you analyze it, it's in essence like feedback loop. Like, was that a good decision or not? And that's exactly what we're trying to get from these numbers, right?
And looking at it from a bird's eye view, so now we're going to go more to the indirect costs. So as I mentioned before, when we're looking at more of the install-based companies, roughly that 32 to 35% is going to be the average when it comes to the overhead costs. So that's right here. You can see this company is around 26. So I would say they're doing pretty phenomenal when it comes to their overhead. But when you go to their direct costs, they're closer to around 58%, where I think a great goal will be more in the low 50s, right? So again, where is there the most opportunity? It's actually within the direct costs here, right? And then, as I mentioned at the beginning of the webinar, okay, is it a pricing issue, or is it an efficiency and a production issue? And then dialing into that, because the reality of it is your team might be working really well. You might have the perfect equipment for the job, but your pricing might be off, right? So, and it's important to kind of have that understanding, and why it's important to maybe even utilize different software and have good systems so that you can make that delineation, and that you can be confident in knowing, okay, this is a pricing issue. So just a couple things to kind of think about. But, again, I think it's good to take a step back from a bird's eye view and look that, okay, the overhead is in a good place. Overhead salaries are being managed well. So overall, this company is doing pretty well. You can see that their net income closer to around 16.99%. Also want to talk about this number, EBITDA, right? So earnings before interest, taxes, depreciation, and amortization. So this is basically what you can look at to determine the enterprise value of your company. So when companies go to sell, this is something that basically you look at this figure, these earnings, and you take a multiple of it. So let's say an install company sells for 3 times your EBITDA, right? And maybe EBITDA in this example is, let's say 600,000, you multiply it by 3, this company's going to sell for 1.8 million. Now, it's nice to understand numbers like that, because then all that hard work that everyone puts into your company, you're understanding, okay, this is the enterprise value. I'm building something that I can ultimately sell or has some sort of value. So having that understanding and being able to kind of track numbers like that. I think, Carla, any other thoughts in regards to this company?
Yeah. So you see that the depreciation and amortization percentages is very low. Like, they're not even showing not even 1% of depreciation, where we see depreciation for the industry closer to like 4%. And again, and that's a huge advantage that this company has. You may be looking at their net income and telling yourself, wow, like that's really good and a good, number, healthy number, but also they're not taking depreciation as much because they are utilizing those subcontractors more, right? So they don't need a lot of machinery and equipment because they're in essence outsourcing a lot of their work to subcontractors. So just something to keep in mind. when you're analyzing your financials, depending on how your business model works,
Yeah. It is interesting sometimes how some of those decisions could have different effects on the company that are maybe weren't even thought of when you were making that decision, right? Like Carla, just like what you mentioned, maybe there are certain negatives of utilizing subcontractors, right? Maybe you're not in as much of control of the quality of work, right? You're not really there to oversee maybe as much as you'd like, right? You don't have that kind of authority over the subcontractors, right? Because they're utilizing their own equipment, they're managing basically their own time, and when it comes to the work, but the other side, on the flip side, like you mentioned, Carla, it could be an easier way to scale, right? You're not having to invest into a lot of the equipment and even the training aspect, right? You don't have to train subcontractors.
I mean, even repairs and maintenance, what do we see? Like 2 to 3% for the industry.
Yeah.
And their repairs is really low. Why? There's no equipment to repair. No workers' compensation. Why? I mean, now they probably have a little bit, but it's probably not even made up. It's not even close to 1%, so it's just something, like Joe said, it's just something to keep in mind, I mean, even rent is really low, probably because you don't have an office space or something like that. So,
but listen, there's going to be challenges in any business model that you have.
100%.
100%. Because the flip side of it too, if you get into a groove and you have a great team of internal employees, you can scale in a great way that way too, and there's always maybe even a little bit more of a risk when it comes to subcontractors, right? Especially if you're only working with one, right? You're kind of in a position where, you're kind of limited even in regard to negotiations or leverage in that opportunity. So, it's always, I think there's always going to be certain challenges in whatever business model you have. But just some examples here, as you're kind of analyzing the numbers. And as we're going through this, we still have a couple to kind of get through, but maybe we could start going through some of the questions in the meantime. Carl, I see a question here, revenue. So like, what is the industry standard for revenue per employee? A good way to kind of think about that is think about how much are you going to pay that employee ultimately, right? Or how much does the average employee get paid in your market? Let's say it's $50,000, right? And again, you can use any number you have, but understanding that maybe for a maintenance company, labor is going to be 30% of the total revenue. So you basically do the 50,000, and you can add labor burden and stuff like that. But this is just as an example. You could do the 50,000 divided by 0.3. And it's 166,000, right? So that employee needs to generate 166,000 of revenue. So in essence, that's kind of what we look at.
That would be their goal for the year to generate. Yeah. And then it's nice if you know that number, right? So we calculated that roughly for a maintenance company, 166. And let's say that that for this year you have like $300,000 in revenue already booked out, then you kind of know, okay, like I'm going to need 2 to 3 employees, right? So I think it's good for calculating capacity as well, right?
Yeah.
Well, 2.
Let's see. So annual decisions should definitely be tracked. 100%, Roger. And it can also decrease morale if your overhead is too low. LLC, is that better than a corporation? So it's just a matter of where you are in your company. Typically, we recommend S corporation, but again, it depends on that. And our tax team could probably give you better advice on that. So the industry standard for labor. So for an install-based company, when you look at subcontractors and internal field labor, so within the direct cost, so it's going to be around 25%. And then more of companies that are doing maintenance, it's going to be closer, closer to maybe around 32% roughly. So that's a general rule of thumb, because you don't have materials in that instance. All right, so we'll definitely get to everyone's questions, but we can kind of continue on through here. But yeah, so this company again, I think overhead, they were doing a great job. Awesome. So we'll go to the next company. So the next company was doing $500,000 in sales, so $500,000 in revenue, and they're doing a mix of services. So
everything under the sun, kind of a thing.
Yeah. So maybe they're doing a little bit of maintenance, a little bit of install, a little bit of irrigation, a little bit of so they have that mix.
Which is what a lot of companies look like, at the 500,000 dollar mark. I think you may have 2 or 3 employees on payroll. You may have some subs that you work with. You probably are still in the field working too at this point. So we need to take all of those things into consideration before you review your numbers, right?
Yeah. Yeah. And so this is, so
they had really great revenue growth.
Yeah. So that's the first thing that sticks out. Yeah. I agree, Carla. When the average company grows at 5 to 10%,
and they're going at 36. I mean, that's phenomenal.
Yeah.
Again, 500,000, so you got to play with the numbers. So
it's a little easier to grow at 36% when you're 500,000.
To 500,000.
5 million, but
yeah.
Still, when you're 5 million, you have more resources to grow as well. So it's, again, there's different challenges, but okay, starting from the bird's eye view, right? So looking at the total cost of goods, 51%, that seems like a pretty good figure, right? Now we're also going to look at total overhead, 25%. Again, that seems like a pretty good figure too, when the average is typically closer to around 35 to 32%. So, from a bird's eye view, I kind of also, there could be kind of at this point when you're doing pretty well in both, you kind of then could dial into each and kind of see, okay, what are, let's start with the.
Well, I think with the overhead, Joe, though, even though they are at a lean overhead, like bird's eye view, 25%, right? But there's a big caveat to that. The overhead salaries are not in there really. It's not even 1%. And that's probably because at a 500,000, you probably don't have an administrative person or a manager yet, because you can't quite afford that. So it's probably a lot of the owner doing a lot of the work, and they may not be getting paid. Or if they are getting paid, their pay is getting rolled up to the direct cost because they're doing a lot of the work in the field, right? So I think that, remember when I told you have to reserve, you kind of have to back into your cost, like, is this company ready to scale? And normally, are you drawing an 8% there? Yeah.
Yeah, I mean, I would say if you're below 10%, but using 8% as an example, so if you build in 8% to your overhead salaries in the future, what does that bring your overhead to? And that's a great point, Carly. It could bring it more to that average, where then 33%. There might be some opportunity.
Then that goes up to 33. Yeah.
Yeah.
And then therefore your net profit goes down.
Yeah. One of the things here where I think that there's then opportunity is looking at your depreciation, where the average is typically around 4%. It looks like this company is a little bit high in that area. So depreciation being really the cost of the trucks and equipment. Yeah.
That's really high. Industry average is around 4%. So seeing 12%, it's, either this company just purchased a lot of machinery, equipment, trucks. They're getting ready to ramp up or something to scale. Or they just bought a bunch of new things that's getting depreciated, because even in the year before it was they were still a little bit heavy, 9. So another thing to think about.
Another thing within overhead, which I think is great, is their repairs and maintenance. So, In 2023, they were around 4.63%.
Right.
And they were able to actually improve that almost 2%. Right. So these are some pretty awesome wins,
So then that's good
when you get stuff
because,
like this.
well, I think that just, Joe, that just goes to show they did buy, they purchased new equipment, machinery, trucks, so they're repairing those less. So that's a good trend. You know, depreciation goes up, but your repairs should go down.
Yeah.
Right.
Yeah. And again, that's another example of how when you make certain decisions, there are those ramifications. Sometimes bad, sometimes good, like in this example.
Right.
So awesome. And then, I think even in regard to, so that's, I would say, that covers some of the main items there. I think we could move on to the last one here. So this last company is doing $2 million in sales, so $2 million in revenue, and doing more of the recurring based services. So not really very material intensive services. So maybe lawn care,
mostly
stuff like
maintenance
that.
or something.
Very interesting. So this company, negative revenue growth. Oh man, that's a bummer, right? That's not good. Is it though? So for this company, it was actually a good thing, and we're going to dive into why. And sometimes that's what it takes. Maybe you're not hitting the profitability marks that you want. Maybe you do need to scale back a little bit, right, or make certain decisions. So again, starting from a bird's eye view, cost of goods, all the direct costs decreased by almost 6%, which is phenomenal, right? And not only that, even before they decreased, they were managing their direct costs pretty good.
So revenue went down, direct costs went down almost at the same rate.
Yeah, which is, and so this company, when the average company is going to be around 50 to 55% with their cost of goods or direct cost, this company's at 40%, which is phenomenal, right? So, that's the bird's eye view of the direct costs, looking at the indirect and the overhead costs.
If you scroll up for a little bit, sorry, Joe, just scroll up. So I want to give myself a pat on the back, but where do I get started, right? Because I don't want to focus on let's just see where we did bad in. What did we do good into? What caused that? So it looks like materials went down from 9 to 5. What did I do differently this year with materials? Did I use a better vendor? Did I have better terms? Was I more accurate in my estimating, right? So I want to determine the wins, and also if somebody was helping me and involved in that, can I compensate them for that or something like that, right? So I think that you want to know if you did well in something and digging into that area, that you see most of that went down due to materials at 4.5%.
Yeah, and that's an interesting thing here. Now, materials decreased. That could be due to two different things. That can be due to, okay, maybe there was an improvement either in the pricing or the efficiencies.
Right.
Or maybe it was just this company doing different kinds of work.
Different kinds of services.
So maybe they were doing less fertilization, right? Where they weren't having to purchase as much stuff, right? So
maybe they developed their niche, which is why the revenue also decreased, because they were more niching into what they were good at this year.
Yeah. So maybe they had dialed into something that was working a little bit better for them.
Exactly. Which is which is why it's a good thing to niche down.
Yeah. So now looking at some of the indirect costs. So this is interesting because I think this is probably the highest overhead cost.
Yeah, that's not looking good. And then my eye goes straight to
overhead salaries.
But I mean, before we even go there, big picture. We want to start off with big picture first. the overhead went down 7% overall. So they can give themselves a pat on the back for that, right, over the last year. But compared to revenue, we're still not at a good overhead rate, right, because it's really high. But yeah, I mean, let's look at overhead salaries. That's almost almost twice the amount that industry averages, you know. So what's going on there? I mean, it could be that they just added on a manager, supervisors, a sales employee, and they're going to look to ramp up and scale or something like that. Like they have to grow into this number now. So if the overhead salary is 20% of their revenue, they're going to have to increase their revenue to grow into that. So that comes back down to 10%, if that makes sense.
And another thing too, even going back to what I mentioned in the beginning, is every company optimizes in their own way. So because this company is performing so well within their direct costs, they're around 40%, whereas the average company is mid-50s. Is this actually the way that they're going to operate and scale? And is this their business model where they're more management heavy, right? They're a little bit more top heavy than the average company. But ultimately, if we scroll down, we look at their net income is 11%, right? A good goal is 15 to 20%. So there is room for growth. But we know that they're doing well in their direct costs. So then where do we then dial into, right? Again, it's looking at the overhead, right? So, okay, can we utilize a software, or is there even a different process we can use to streamline the administrative sides of the company?
They were in a negative position last year too, which I just saw.
Yeah.
So that's good. I mean, that they're positive, but you're right. Like, are there certain softwares, or should we just focus on sales this year to try to compensate for these salaries? You know, I think that's where my mind would go as a business owner. Like, what do I need? What kind of sales do I need as a goal so that I can keep these overhead people and give my sales staff like goals, right?
Yeah, because instead of looking at it as if you have to cut costs,
right,
to get to where you need to be, you can also look at it that you're just not at capacity. So your current resources, you can actually produce more with it. Right. So it's not always technically a bad thing. It's just the stage of where you are in regards to your capacity. But another interesting thing, like even when you look at, and it's overhead's an interesting thing because it's kind of a lot of those small expenses, but when you add them up, it can make a difference. So insurance, the average for these kind of companies is closer to around 2.8%. So there's 1% where you probably have opportunity. Also looking at repairs and maintenance. So this category, you're probably about one percentage point above where you could probably be. Telephone, this is very high. Again, you're about 1%, right? So just there, you're at around 3% opportunity. Also looking at things like your dues and subscriptions. This is about 1.5% higher than the average company. And then advertising and marketing, right? So I think that.
So you found like 5%.
Yeah, I would say, again, this company needs to dial into their indirect costs. But Carla, like you had mentioned, and this is why it's important as the business owner to have an understanding of where your company's at capacity wise. Maybe it just means that we need to produce more, right? And that's how we're going to recoup a lot of our overhead costs as well. And listen, you can see this company, they went from what was it, negative 1% last year to almost 12% of net income.
That's awesome. That's
so
great.
Listen, if they continue in this trend, even if they increase it half this rate, so only 7% this year, then their net profit's going to go to around roughly almost 19%, right? Which is great stuff. So please, anyone have any questions? That pretty much. I looked at the clock. It's around 5, so that'll pretty much wrap up the formal presentation. But yeah, definitely questions. If you have any.
Someone said, "What's the best method to separate install from maintenance?" So for that, you need to set up class tracking or division tracking on QuickBooks or whatever accounting software you have. And you would have to, when you're coding in your expenses, it will prompt you to choose a division. So you would either choose maintenance or install. I think the biggest thing is like tracking down receipts and putting a receipt policy in place for the company first. And then seeing how you'll be able to track people's time. Like if certain people work in certain divisions, that's great. So then you could just say, okay, well, Jim just works in the install division. So his salaries and wages is always going to be broken down and categorized to that division. But if Jim is cross-trained and works in both, then you're going to need time cards, right? Like you need a time tracking stuff. So that's where I would get started. I think that, Hillary says, "I'm looking at my QuickBooks Online as a percentage of income. My husband and I take draws. How does that play into the profit and loss? It says our net income from last year was 40%. So, right, because your P&L does not have your overhead salaries, which in essence would be 10% of your revenue, let's say, then your net income would be higher. So you would take that 40 and minus the 10, and you would land around 30. But it just sounds like maybe you and your husband are doing this together and don't have other, like of those larger expenses that we spoke about, like rent, utilities, which take up another like 3 to 5%. So I would subtract that from the 42. And I would also, if you don't have any other field laborers either, I would subtract another 25 to 30% from that. Yeah. Right. So this is what we're talking about, like backing into things and seeing if your company is ready to scale.
Yeah. And as part of our services, and I know that was a question in regards to like the industry standards and the benchmarks. So it's important to utilize the same chart of accounts, but that's what we do for our clients. So you'll be able to see a lot of this information directly correlated to the exact benchmark for that service line as well. So what is the best method to separate install division?
I already answered them.
Okay, awesome. Any other questions, everybody? I just want to make sure to scroll through this.
Yeah, and if you think of anything else, feel free to reach us at this email here on the screen. Give us a call, visit our website, schedule a meeting with us as well.
I do see also, so again, our next the second webinar of this 3-part webinar series is on Friday at 4 p.m. Eastern. So you'll get some emails in regard to that as well. So we're going to dive into the balance sheet there. I do see, so the question from Katrina, so like how much do you basically like mark up the work if you work with subcontractors? So it depends like what they're going to be responsible for and how little your administrative team is going to have to be involved. We've seen anything from 10 to 40%, kind of depending on that. So to kind of tack on to that. We're going to make sure everyone has the recordings of this as well. And awesome stuff. Well, yeah, hope everyone has a great rest of your day here, and we'll see you all on Friday.
Yeah, thanks for participating. Bye.